Today, we're diving into something that I know a lot of you have been asking about, managing risk in your investments.
It's a big one.
It is a big one. We've got a ton of your questions and sources right here in front of us, ready to go. So let's just jump right in.
Sound good.
Okay. So the first thing that really jumped out at me from what you guys have been sending in is this idea that every investment, every single one, comes with some level of risk.
Yeah, that's definitely a fundamental concept to understand. There's no such thing as a completely risk-free investment.
Right. I mean, you hear people talk about safe investments, but even those.
Exactly. Even something like putting your money in, say, a high-yield savings account, it still carries a small amount of risk.
Right.
Inflation could outpace the interest you're earning. There's always some factor out there, right? But I think the important takeaway here, and this is something that really resonated with me in the material you sent, is that risk isn't inherently bad. It's about managing it. It's about understanding how much risk you're comfortable taking on.
Okay, so risk is part of the game. And it sounds like the key is not to avoid it completely, but to kind of be smart about it.
Exactly. You got it.
Yeah.
It's about aligning your investments with your financial goals, your timeline, and how comfortable you are with the possibility of things, fluctuating a little bit or a lot.
So how do we even begin to wrap our heads around managing something as complex as risk? Because, I mean, it feels kind of big and scary sometimes.
Yeah, it definitely can. One of the sources you shared used this analogy of a seesaw to illustrate the relationship between risk and reward, and I think it's a really helpful visual.
Okay, I like that.
So imagine, right, risk on one side of the seesaw, potential return on the other. The higher you go on one side, the higher you go on the other. They're interconnected.
Oh, I see. So the higher the risk you're willing to take, the higher the potential rewards, but also the higher the potential for things to go the other way, too.
Right, and that's what we call the risk-return trade-off. It's fundamental to investing.
It's a trade-off, like you said. Okay, that makes sense. So can you give us an example of what this might look like in the real world?
Sure. Let's take two common types of investments, stocks and bonds. Imagine you have, let's say, $1,000 to invest. Historically, stocks have had the potential for higher returns over the long term, but they also tend to be more volatile than bonds.
Okay, hold on. Let's break down that word volatility. What exactly does that mean?
Good point. Volatility basically refers to how much an investment's price fluctuates, how much it goes up and down over a certain period.
Gotcha. So a volatile investment would be like a roller coaster ride. Lots of ups and downs.
Exactly. And a less volatile investment would be more like a, slow and steady train ride.
Okay, that makes sense. So stocks are the roller coaster and bonds are more like the train.
You got it. Stocks are generally considered riskier because their prices are influenced by a lot of factors. Company performance, economic news, even just overall market sentiment. Bonds, especially government bonds, tend to be seen as safer, especially in uncertain economic times. So they're less volatile, but they might not offer those same sky-high potential returns.
Interesting. Okay, so you've got this risk-return trade-off, you've got stocks, you've got bonds, you've got volatility. It's a lot.
It is a lot. And that's where understanding your own personal risk tolerance becomes really crucial. How comfortable are you with the ups and downs? Can you afford to lose any of the money you're investing?
Yeah, those are big questions.
They are. And every investor needs to ask them. There's no right or wrong answer. It's about what's right for you.
And that's something we're going to dive into much deeper in just a bit. But first, we need to take a quick break. We'll be right back after this.
So before the break, we were talking about risk tolerance and how there's no one-size-fits-all approach to investing.
Exactly. It's so personal, isn't it? Everyone's got their own comfort level when it comes to risk. Your age is a big factor, for example.
Okay, so how does age play into it?
Well, if you're younger, you have, more time to recover if an investment doesn't go your way. So you might be a bit more willing to take on some risk, knowing you have more time to make up for any potential losses. Someone closer to retirement, they might be more cautious. Makes sense, right?
It does, yeah. They're probably more interested in protecting what they've already built up.
Right, exactly. And it's not just age, of course. Your income, your financial goals, those all play a role too. So someone with a larger income might be more comfortable taking bigger risks.
They could be, yeah. Or someone with really ambitious financial goals. They might be willing to take on more volatility to try to reach those goals faster.
It's really interesting to think about all the different factors that come into play. And it's not even just about, your finances. Your personality probably plays a part in it too.
Oh, absolutely. Some people, they just naturally gravitate toward risk. They love that adrenaline rush of potentially big payoff.
The thrill of the chase.
Exactly. But others, they find that whole idea really stressful. They much prefer a more conservative approach, something slow and steady. And that's perfectly fine, too.
Mm.
One of the articles you shared even mentioned those risk tolerance questionnaires you can take online.
Yeah.
Those can be super helpful in figuring out where you fall on that spectrum.
Yeah, that's a good point. Knowing yourself, knowing how you react to risk, that's probably half the battle.
I'd say so.
Okay, so let's say you've got a good grasp on your risk tolerance. What's next? How do you actually put that knowledge into practice when you're making investment decisions?
That's where this whole idea of diversification comes in. Remember that saying, don't put all your eggs in one basket.
Oh, yeah, classic advice.
Classic for a reason.
Yeah.
It's all about spreading your investments around, so you're not overly reliant on any single one of them.
So instead of investing all your money in, say, one single stock, you would spread it out across different stocks, different bonds, maybe even other asset classes like real estate.
Exactly. You're getting it.
Mhm.
The idea is that if one investment takes a hit, the others can help cushion the blow.
It's like having a financial safety net, right?
I like that.
Yeah.
Yeah, that's a great way to put it. Think about it. Imagine you invested all your money in, say, a company that makes, I don't know, self-driving unicycles.
Okay, very specific, but I'm with you.
And then suddenly, boom, something happens. Turns out people aren't as into self-driving unicycles as we thought.
Oops.
Right. If that was your only investment, that would be a
Yeah.
cut situation. But
If you had diversified and only a small portion of your money was in self-driving unicycles, then it wouldn't be such a big deal.
exactly, the impact would be much smaller because the rest of your money is spread out across different investments. Hopefully some winners in there.
Okay, that makes a lot of sense. So diversification is all about not having all your eggs in one basket. But how do you actually go about doing that? Like, how many different investments should you have?
That's where asset allocation comes in. And it ties in really closely with this whole idea of diversification. It's like the next level up.
Okay, so tell me more about asset allocation. What is it and how does it work?
Essentially, asset allocation is about deciding what percentage of your portfolio you want to put into different asset classes, like stocks, bonds, real estate, that kind of thing.
Okay.
And this is where your risk tolerance comes back into play.
Ah, right.
A more conservative investor, someone who really values stability, they might choose to allocate, say, 70% of their portfolio to bonds and 30% to stocks. Because remember, bonds are generally considered safer, less volatile.
Got it.
But someone who's more comfortable with risk, maybe they're younger or they have a longer time horizon for their investments, they might go with a 70-30 split the other way around. 70% stocks, 30% bonds.
So it's about finding the right balance for your personal comfort level.
Exactly. And it's not something you just set and forget. Your life changes, your goals change, your risk tolerance might even change over time. So it's good to revisit your asset allocation every so often and make sure it's still a good fit for you.
It's an ongoing process.
It is. It really is.
It's really important to remember that investing isn't just about, like, what you invest in, right? It's also about timing. And speaking of timing, we're recording this on September 27th, 2024, and, well, the market has definitely been interesting lately, to say the least.
You could say that again. Lots going on.
Right. It's a good reminder that there are all these external factors that can impact our investments, things that are totally outside of our control, like what's happening in the broader economy, interest rates, inflation, even global events.
Absolutely. You can't ignore those macroeconomic trends. They play a huge role.
So how can listeners stay on top of everything? I mean, it feels like a lot to keep track of.
Yeah, it can be overwhelming. One thing that came up a lot in the material you sent is the importance of staying informed. Reading financial news, listening to podcasts like this one, obviously,
Hookers.
even just like following some economists or market analysts on social media, it all helps.
Right. You've got to stay in the loop. But even with all the planning in the world, even if you diversify, even if you understand your risk tolerance, investing can still feel kind of emotional sometimes. At least it does for me.
Oh, for sure.
Yeah.
That's totally normal. It's your money.
Right.
It's your financial future. It's going to evoke some emotions.
It's like my brain knows I should be staying calm when the market dips, but...
But your gut is telling you to panic.
Exactly. It's hard to ignore that gut feeling.
It is. It really is. One of the sources you shared actually called it emotional discipline. And I think that's a great way to put it. Because that's really what it is. Being disciplined enough to stick to your plan, even when things get bumpy.
It's about not letting those short-term market swings derail your long-term goals.
You got it. Because let's be honest, no one can predict the market perfectly. There will always be ups and downs. Always.
True enough. So, are there any specific strategies that can help us, manage that emotional side of investing a bit better?
Definitely. Your sources mentioned a few, actually. One that I personally find really helpful is dollar cost averaging.
Okay, tell me more about that. I've heard of it, but I'm not sure I fully understand how it works.
It's actually pretty simple. Let's say you want to invest, say, $1,000 in a particular stock, but you're worried about buying at the wrong time.
Makes sense.
So with the dollar cost averaging, you divide that $1,000 into smaller amounts. Maybe you invest $200 a month for 5 months.
So, you're spreading out your investment over time.
Exactly. That's the key. Because some months you'll be buying when the price is lower. Other months you might be buying when it's a bit higher. But over time, it can help you average out your purchase price.
And hopefully minimize the impact of any short-term fluctuations.
Exactly. It's like taking the emotion out of it. You're not trying to time the market perfectly. You're just consistently investing over a set period.
I like that. Consistency is key.
Mm.
What about other strategies?
Another good one, especially when it comes to individual stocks, is setting something called a stop-loss order.
Stop-loss order. Now, that one I'm not so familiar with.
So basically, a stop-loss order is like an insurance policy for your investments. It's an instruction you give to your broker to automatically sell a stock if it drops to a certain price that you set.
Okay, so it's like putting a safety net in place.
Precisely. So let's say you buy a stock for, say, $50 a share, and you set a stop-loss order at $45. If the price drops to 45 or below, your broker automatically sells it, limiting your potential loss.
Oh, that's pretty cool. So you're protecting yourself from the downside.
Exactly. It's not foolproof, of course, but it can definitely help manage risk, especially if you're worried about big price swings.
That makes a lot of sense. So we've talked about diversification, risk tolerance, asset allocation, even some strategies for managing our emotions. Is there anything else we absolutely need to remember when it comes to managing risk in our investments?
Honestly, I think the most important takeaway from everything we've discussed today and from all the amazing sources you guys sent in is that learning about investing is an ongoing process. The more you learn, the more confident you'll feel making decisions, even when the market gets crazy.
It's a journey.
Exactly. And like with any journey, it's always helpful to have a map. So take what we've talked about today, do your own research, maybe even talk to a financial advisor, and start building your own investment strategy, one that aligns with your goals, your risk tolerance, and your vision for the future.
I couldn't have said it better myself. This has been awesome. Thanks for joining us on this deep dive into managing investment risk. We hope you feel as energized and empowered as we do to take control of your financial future. And remember, keep those questions coming, keep learning, and most importantly, keep investing in yourself. See you next time.